Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. Over the past several weeks, investors feared that escalating tensions around the Strait of Hormuz could trigger another global inflation shock. Given that roughly one-fifth of the world's seaborne oil passes through this narrow waterway, even a temporary disruption has the potential to send energy prices sharply higher and reignite inflation concerns. But the latest shipping data tells a more reassuring story. Instead of a complete shutdown, the number of vessels transiting the strait initially collapsed during the height of regional tensions before gradually recovering. Oil tanker traffic, while reduced, never disappeared entirely, and commercial shipping continued to find ways to move through the corridor. The sharp spike in disruptions proved to be temporary rather than structural. That distinction matters enormously for financial markets. Inflation is ultimately driven not by headlines, but by sustained constraints on supply. A geopolitical shock only becomes inflationary if it creates a prolonged reduction in energy availability. Temporary disruptions may lift oil prices for a few days or even a few weeks, but unless inventories tighten materially and physical exports remain constrained, those price spikes typically fade as risk premiums unwind. In many ways, this resembles previous geopolitical episodes. Markets initially price in the worst case scenario, volatility explodes, oil futures surge, and investors rush into inflation hedges. But as shipping normalizes and actual supply continues flowing, expectations reset. The geopolitical premium embedded in crude prices begins to evaporate. That has important implications for the inflation outlook over the second half of the year. Energy has been one of the biggest upside risks to inflation expectations. If shipping through Hormuz continues to recover instead of deteriorating further, oil prices are less likely to experience the sustained rally needed to reverse the broader disinflation trend already underway in many developed economies. For the Federal Reserve, this removes one of the key external risks that could have delayed policy easing. The Fed has consistently emphasized that it is watching both realized inflation and inflation expectations. A persistent energy shock would have complicated that picture by pushing headline inflation higher and potentially influencing consumer expectations. But if the Hormuz disruption proves temporary, policymakers can focus once again on softer labor market conditions, moderating wage growth, and easing underlying inflation pressures rather than reacting to geopolitical noise. Markets have repeatedly learned that central banks generally look through short-lived commodity spikes unless they threaten to become embedded in broader price dynamics. A fading geopolitical risk premium therefore strengthens the argument that inflation can continue moving toward target without requiring additional monetary tightening. Of course, risks remain. Any renewed military escalation that materially restricts tanker traffic would quickly change this assessment. The Strait of Hormuz remains one of the world's most important energy choke points, and its strategic importance has not diminished. However, based on the latest shipping data, the feared worst case scenario has not materialized. Instead, the evidence points toward normalization rather than prolonged disruption. If that trend continues, one of the largest upside risks to global inflation is gradually fading, giving the Federal Reserve greater confidence that the next meaningful move in interest rates is likely to be lower rather than higher. For investors, monitoring shipping flows through this critical corridor may prove just as important as watching the next inflation report, because the recovery in physical trade is quietly reinforcing the case for continued disinflation and eventual Fed rate cuts.